I go to Atlanta, I go to Miami these days. All these condos have accelerated rapidly in price. In '08 and '09, hundreds, if not thousands, of units in those cities were sitting vacant.
From 2004 to 2008, commercial real estate prices rose 66%, but crashed by nearly 40% during the 2008 financial crisis. Headlines like global economic shock worse than Great Depression and financial crisis is the worst the world has ever faced reflected how severe the crisis was. Tim Vest was on the front lines of this crash, and he survived to tell the story. He's here today to share the lessons he learned, the changes he made, and how he's using his previous challenges and setbacks to not just survive, but thrive in any investment environment.
So I started in '06, and I was investing in land, just raw land. You're in the Carolinas, so you're familiar with the coast and the mountains probably. Um, so a lot of our land was in the coastal areas of South Carolina, sitting on the marsh, or in the mountains of North Carolina, which has always been a very very popular spot for retirees. Um, so we were going and buying like 100-acre parcels of land in the North Carolina mountains with just a whole bunch of trees on it, no roads, no infrastructure whatsoever. And then we were partnering with developers to understand what they would do with it, what they would pay for it once we got it entitled. And then we would even go so far as to work with them to help them get infrastructure in once they bought the land from us. So sometimes, we were getting the land and you know making money three times on the same piece of land. We would sell it to the developer once we got it entitled. So we'd pay like 100,000 to keep it easy, get it entitled, flip it off to the developer for 500,000, and then when they would get it for 500,000, they would utilize our cash and credit to put infrastructure in, and then we'd sell it to them again, um, or create some sort of return. That's not abnormal. You see a ton of people doing that today. Land is very, very hot today, just because of the shortage that we have going on with housing in this country. Um, but back then, that went really, really well in '06, '07, first part of '08. But then '08 and '09 came, and we had a situation back then that was very different from today, where we had an oversupply of housing. Um, we had, I tell people all the time, I'm like, I go to Atlanta, I go to Miami these days, and there's all these condos that have just accelerated rapidly in price. In '08 and '09, a lot of those condo buildings were sitting vacant. There were just hundreds, if not thousands, of buildings or units in those cities that had nobody. Nobody lived in them. They were just vacant. And you saw a lot of that too in the suburbs and towns outside of the cities, where there were these like huge plots of land with homes on them that nobody lived in. There's always the joke that back then, somebody working at the gas station owned three homes, right? um there's some other jokes back then that we won't go into, but that that came from some very loose lending standards, right?
Before we go any further, can you expand on what caused the 2008 crash?
Yeah. So the under the underlying, if you guys have ever seen the movie, I think it's called The Big Short or whatever, they do a really good job of explaining it. And I'll dumb it down even more because this is kind of like my dumb understanding of it. Essentially, lending standards were very loose, and I can give you personal examples of it. Lending standards were very loose. They would walk loan banks were giving loans on stated income. You could walk in, didn't even have to produce a pay stub. You could just tell them what you made. Sometimes they'd ask you four times, "What did you make?" Until you gave them an answer that would qualify you for the loan they wanted to give you. And they would do things like submit all your applications at once, and all of a sudden, when you maybe qualified for one $300,000 house, they'd approve you for four $300,000 homes. Those were just some of the examples that were going on. Banks got very loose with it, and then at the end of the day, this caused a high rate of defaults. Back then there was something going on that's going on today as well. There were a lot of ARMs, adjustable rate mortgages. People were not only taking more loans than they could afford, so they were over leveraging themselves. And part of the reason they were able to afford that was they were taking these arms where they were paying like 3%, 4%, and then the rates would adjust over like a 2, 3, 4 year period. And the next thing you know, you had more than you could afford, and you were paying 6% interest instead of the three that you started with. Um, think about that today with these floating rate loans without locks on them. And we're starting to see some of the same thing, right? With all these guys who bought multifamily properties, that they were paying 3 and 4%, and today they're at 9, 10, 11, 12%. It's that there's some similarities in what's going on with lending today and what went on back then. But essentially, that's what happened in 2008 and 9 is people got over leveraged, they couldn't pay their mortgages, and they started turning in their loans. Um,
We are seeing a lot of banking collapses right now, and that's a major parallel to what happened in 2008. And I wanted to know what was the impact on the commercial real estate space back then, and specifically, what were some mistakes or missteps that commercial real estate investors were making back then?
yeah, 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 sure. To the first part of the question, some of the missteps, right, that lenders were making were they got greedy. Honestly, lenders got greedy. I'll give you an example of one lender that we talked to. We didn't take them up on this, but me and one of my business partners walked in, and we knew that we could afford about $500,000 in properties, and we had about $1.6 million in properties that we were considering. Well, the lender literally told us that if we submitted for all of them all at once, that their system could not tell that we were the same entity trying to buy all these properties, right? So it would approve us for everything that we wanted. And he knew that we couldn't afford it, but he was willing to do it. Um, so banks, that was not abnormal for banks. They were doing that kind of thing. So that's part of what was going on. The folks were just, I mentioned it before, people were just simply over leveraging themselves. And then essentially getting into situations where they had assets that did not cash flow. And that was probably one of the biggest lessons for me at the time. Is hey, don't buy assets that don't cash flow. Land is great. Don't get me wrong. From 2006 to 2008, we probably 5, 6, 7 x'd our money. I mean, we were making money hand over fist. Um, for me, one of the lessons learned from that was, hey, when you make money, uh, take some of it back and set it aside, right? Let's say I started with 200,000. Next thing you know, I had 800,000. We'll take my initial 200,000 back and put it back in the bank and don't use it, right? Only play with what you make, right? So that would have been kind of a lesson learned for me that I've deployed moving forward. And then one of the other lessons learned for me was I don't buy anything today that doesn't cash flow, that can't pay for itself at least. Ideally, that's putting money in my pocket as well. So that's one of the big lessons for me. Um, I think one of the things you've seen from banks moving forward though is they aren't as risky as they used to be. They're a lot stricter now on lending standards, and folks that you hear a lot of folks saying today that we're seeing the exact same thing we saw in '08 and '09. That's just not the case. There's a couple of key differences there, and one is that banks are less risky. They're not doing the same things they did back then. They're not doing stated income loans. They are requiring proof and documentation of where your money's coming from, what you actually make, what your cash flow looks like. Those no doc loans that were taking place back then, you see a lot less of them now. Um, and then the other thing is banks are actually lending today. In '08 and '09, lending stopped. I mean, you could not get another loan. If you're willing to pay the interest rate today and you can afford the interest rate, you can get lending today. Um, and that's a huge difference from back then. If it, if I'm looking at one key difference today that kind of makes me feel better about the way things are today, then that's one of them.
Since you are coming from that place of wisdom where you actually went through it, is there any part of you that maybe thinks it's just because it's too early for that to happen, but that could potentially get to the point where banks just completely stop lending, or is there something completely different about this environment that that suggests banks won't make that move or pause?
I think one of the big, I think there's a key difference there. One is I think banks are in a lot better position for the most part. You mentioned kind of the bank failures. We are seeing some bank failures, right? You've seen, what was it, the Silicon Valley Bank, SVB. You've seen some others, but you're not seeing it at the scale that you did. I would be shocked to see. Back then it was Wachovia. That was one of the biggest ones, right? Wachovia, they were, I think they were the fifth largest bank in the United States, and they were failing. Like they had to be bought, they had to be purchased in order to make it. The Fed had to step in. You're not seeing banks of that scale fail. Like I would be shocked to see a Bank of America or a Chase or Wells Fargo or someone like that or a Truist fail right now. It's mostly the smaller regional banks, which, I mean, don't get me wrong, I don't want to downplay that. That's still significant, but it's not to the scale it was then. And then, two, one of the other things I think we're seeing is, I mentioned before, that oversupply. We do not have an oversupply of housing in this country right now. We have a very, very large deficit, actually, undersupply, and that's a huge difference. There is going to be a demand for housing, and we're not seeing the issues that we saw before, where basically property values just plummeted, and that was one of the biggest issues, right? Is that banks, not only were they over leveraging, and they were making poor loans, on top of it, real estate values just crumbled, absolutely crumbled. For instance, you asked for one of my own examples. We had a piece of land that we paid $193,000 for on the marsh in South Carolina. By the time everything settled and everything was done, um, we owed about $160,000 for that property, and it was worth maybe $15,000. You know the that's the way that property devalued itself, or depreciated over that time. And then banks came in and basically said, "Hey, the federal government gave us all this money. They get the surplus, right? Sorry, the stimulus. The federal government stepped in and they put all this money into these banks, gave it to them. But part of the stipulation for that was, now go clean up your books." So the federal government gave the banks all this money and then said, you got all these risky loans, we want you to get rid of them. So they came to people like me, who weren't behind. I was still servicing my loan. I was still paying the payment, even though it was worth a tenth of what it was before. But they came to me and said, "We think you will default, so we're going to go ahead and force you into default." um, and when you're faced with that, it's like, do I write you a check for 160,000 to pay off the loan, or do I look at you and say, I'm going to keep my cash, and if you're going to force me into the default, then I'm just going to stop paying? And that's the situation a lot of us were facing at the time.
Yeah, and I mean, it seems like that was absolutely an unprecedented experience for a lot of investors like you at the time. I think that is similar in the way a lot of investors today are experiencing this high interest rate environment where they've never seen interest rates rise at the rate they have. And so that's a really interesting parallel. I mean, and I know there's a lot of investors who emphasize the importance of studying history and seeing what has happened in previous recessions, because history repeats itself. And though, yes, like you mentioned, there are differences, learning from people like you who were in those trenches then, you guys are just so much more prepared to handle something like what we're going through now.
Yeah, and then I think you hit on something too. Is rates rates today really aren't that bad. They seem bad because they were so low and then they rose so quickly. That's why it feels bad. But I'll tell you, my first home, the first house that my wife and I ever bought, our interest rate was like 8.25%. Um, back in 2000, I don't remember when it was, but my first home loan was over 8%. And you can still get a loan today for in the sixes. For primary residence, maybe 7%. That's really not that bad historically. It just feels bad, right? It just feels bad because property prices appreciated so quickly. They accelerated so fast. And then the interest rates did the same thing, right? We went from like 3% to 6% in 12 months. And that hurts. That's very quick. And then, from the multifamily side, we all underwrite with rules of thumb and assumptions. And, the rules of thumb tell us what, 10 bips per year of ownership, right? Um, well, we blew that out of the water. If you were conservative and you wrote that in, and we've gone way past that, then you're behind. I'll be full disclosure, me and my business partner, we're pretty conservative on our underwriting. And even in our underwriting, we're behind on some of our performers in terms of what we underwrote our refinance rate to, because the market has accelerated way beyond the rules of thumb over the last year in terms of interest rate. But that's okay, right? Because at the end of the day, and again, this is kind of what I think some folks have lost sight of. At the end of the day, real estate's typically a long-term hold. This idea of like, I'm going to buy it and a year from now, I'm going to flip it for a 30% return, 40% return. I'm going to 2x my money in 2 years on real estate. As a whole, that's not how real estate has traditionally been. And, if you follow some key fundamentals of, I'm not going to buy anything that can't pay for itself, I'm not going to go get floating rate debt, if I can help it. So if you've locked in a rate and it pays for itself, and all you're doing is just missing your refi window, but you can continue to pay the loan and the property cash flows, then you're okay. You can wait it out. Um, and that's my business partners and I have those conversations with our investors all the time. It's like, hey guys, like, I know you're expecting capital back right now, and we can't give it to you because we thought rates would be 5.5%. Like, we purchased properties and our interest rate was 4%. And we thought we'd be at 5.5 during a refi. Well, we're at 6 right now, 6.25. It's not a good time to refi. So we're going back to our investors and saying, hey, listen, I know we said we were going to give you all your capital back at this point, but we're not. But the good news is you're going to continue to earn your pref. The property's cash flowing nicely. The equity's there. We're just not tapping it, right? So your equity's there. Your capital's fine. You're going to continue to receive distributions, which they are. We just need to wait a little longer before we refi it. And that's kind of that's the message right now, right? And that's way better than some of these other messages like, hey, we bought 3,000 units, we overpaid, and we're skipping out on it. Yeah. Yeah. Yeah, so in full disclosure, I didn't step away from real estate. I just had to stop for a little bit because, like I said, I had a lender that showed up saying pay us, right? Even though I was current, they were saying pay us, and I said no. So it took a good year and a half, 2 years for me to work through some of the stuff. I had to clean up a mess, right? So it took me a good year and a half, 2 years to clean up that mess. And it was really painful. I ended up losing everything that I had made between 2006 and 2008, and then some. Um, so I lost my properties. I lost the profit I made. My business partners, same with them. Now the good news for us is that we at the time I didn't even know what syndication was. So we weren't taking investor capital. Everything we did was our own money. So the only money we lost was ours. So that's good. At least at that point, the education that I paid for was just my own money. So I spent the time cleaning that up. Around 2010, I started to get back into it, and that's when I started to look at fix and flips and single families. And honestly, Kerwin, that's primarily because I knew I could do that. And for the capital that I had, that I was kind of rebuilding myself, that's a place I could go. And I was doing that on my own. In 2010, there was tons of foreclosures. There were a ton of distressed properties that you could find for pennies on the dollar, literally pennies on the dollar. Um, and they weren't hard to find. You could get them on the courthouse steps. You've all heard about the foreclosure auctions and the sheriff sales on the courthouse steps. think that's how things happened then. And then two, it was real easy to just drive through a neighborhood and just see the grass that was 6 inches tall, foot and a half tall, and just call that property or go look that property up and end up with it. It was easy. It was honestly easy, and there was a ton of it. So I did that for a while until about 2018, and then I just just pivoted. I guess I just said, hey, I don't want to do the single family stuff. I want to scale bigger than that. So I sold off everything I had and moved into multifamily around that time.
Losing as much as you did, I imagine a lot of people would have ran away from real estate. It's clear that you didn't because you're very successful now and you've been able to more than bounce back. What gave you the confidence, especially in the aftermath of that, in real estate, that investing in real estate would produce rewards that would outweigh the risk that you were obviously well aware of that there's risk in real estate?
Yeah. So good question. For me, it was just kind of keeping perspective on things, right? I've always kind of had a long term view of a lot of things, and real estate's one of them. I knew I knew that was just a blip, right? Um, I in my mind, that was a blip that was caused by poor lending standards, was caused by greedy people, myself included. Like I said, hey, I should have put some of that money back in the bank. I was making it hand over fist. We were 2x in every 6 months, and I'm like, this is going to go on forever, um, and it didn't. So for me, it was just kind of looking back and going, you know what? I should have done this instead of that. And if I do this moving forward, I'm okay. Because one of the things I did notice coming out of that was the guys who were in a position to ride that wave out, to ride the dip out, when the dip started to correct itself, they did really, really well. And that was one of the things I said to myself that whole time I was working through it in like 2009 and 10 is I'm looking at it and I'm going, I'm not going to be on the side I was on next time. I just kept telling myself, next time something like this or something similar happens, or the next time we have a dip, I'm going to be in position to benefit from the dip. Because the guys who were disciplined and followed some of those rules of thumbs, like don't buy non-cash flowing assets, don't get over leverage, things like that, and the guys who had good liquidity when these deals started coming down the pipe in 2010, 2011, and 12, they snatched them up and they crushed it. I had a front row seat. The guy who got that property I was talking about that I lost in South Carolina, he got 160,000, a property I paid $190,000 for. He got that for 3,500 bucks. He got it for the taxes that I owed on the property. And
Wow.
because he got the tax lien, he got himself in front of the bank, in a position in front of the bank, and he was able to force the bank to just basically forgive the loan. By the way, that was a benefit to me. He was able to rush the bank. The bank couldn't perform in time. So the bank forgave my loan rather than foreclose on me. So that helped me. But for him, he got a property for 3,500 bucks. And I think at some point he ended up building something on it and selling it. I think he sold it for, I don't know, 500, 600 grand. He was all in for like 200. He was in the position I wanted to be in. And so I was able to see those things and just say, hey, if you're in the right spot and you don't make stupid decisions like I did, then this whole real estate thing really, really does pay off. It's just like anything else, right? It has peaks and valleys, and as long as you're able to ride out the valleys and get back to somewhere up towards the peak, then you're in a good position. And that's kind of where we are today. And somebody a few weeks ago looked at me and my business partner and said, you guys are in a unique position. He goes, statistically, everything you purchased in the last 2 years, you should be bankrupt on right now, right? But we're not. In fact, we're in a pretty good spot on everything that we own, and that's because we've been disciplined over the last 2 years. We've done a lot of deals, but we've been pretty smart about the way we've done them, and we haven't put ourselves in a position where we have to refinance anything right now. And that's been a huge key. And one of the lessons I learned from 2008, which was make sure no matter what debt you put on it, either lock in low and lock in for a long time, give yourself 5 to 10 years, or if you are doing some sort of bridge financing, don't go floating rate, lock in and then have extensions available. And the extensions may cost you money, but they're not going to cost you your property. So anything that we have that is a bridge, we've got another 12 to 18 months before we have to do anything. And even on those, every single one of them has at least 2 1-year extensions that we can purchase. Uh, so, I feel pretty good about where we are. And a lot of that comes from just getting my ass handed to me in 2008, if I'm being honest.
No, I appreciate you sharing that. And obviously now today you're wiser, you're older, though you don't look older. And of course you're more experienced. And so if there, and you did touch on this a little bit, but if there is a recession or a downturn, like some of the headlines today we're seeing are sort of warning us about, what are you doing to prepare as an owner operator right now?
Yeah, so good question. So one of the things I'm doing is I'm understanding what my finance options are. I'm talking to my lenders, I'm getting in front of them. That's another thing 2008 taught me was, get in front of your lenders. Don't be afraid to talk to them. So I'm doing that. And then the other thing too is I'm not right now for me, cash flow, cash flow and occupancy is key. Keeping delinquency low is key. So I'm not out trying to push rents right now. I'm not out there trying to say, "Hey, I'm collecting 1,200 today. Let me see if I can get 1,350." I'm saying, "Hey, I'm collecting 1,200. Let's do a reasonable, cost of living increase. Take it to 1,225, maybe 1,250, something like that." Um, but then two, let's make sure that we keep occupancy high and delinquency low. And that's where my focus is. So if I have to go for a smaller rent increase or even no rent increase, but I can keep my tenants paying, and that's the key for me right now. Um, and then the other piece that I'm really, really focused on is expenses. Rather than try to drive income, I'm trying to reduce expenses. And I'm doing that a number of different ways, which for me, which is one of the things I was talking to somebody about this morning, is, I've been able to create some scale. So if you have scale, like you guys, I think you and your brothers have some decent scale right now. Go out and leverage that scale for your materials. Um, Takes a little bit of an effort, but go out and talk to the suppliers and say, hey, I'm going to buy X amount of flooring, X amount of lights, X amount of whatever over the next year. What's my price look like if I commit to purchasing this many of each, and don't just buy per unit as the units come up. Go ahead and plan it out. Takes a little extra planning, takes a little extra, you know time and conversation, but it really can drive your expenses down. So those are the ways I'm trying to increase value right now, is just be very conscientious on, keeping my occupancy up and keeping my expenses down.
Multifamily has been heralded as a strong recession resilient asset class for some time, and I believe it bounced back faster than other asset classes in 2008. So this next question is kind of twofold, but can you touch on why a lot of people see multifamily as such a resilient asset class, but also are there any concerns you have about multifamily in the looming recession and or downturn if there's one to come?
Yeah, so, I think the reason people look at it as recession resistant is, because and remember, not all multifamily is the same, right? Like I would be I would be really concerned about A class properties right now. Again, that kind of goes back to my don't try to push the top of the market right now. And A class does. Now, the other thing about A class is it tends to have lower expenses, so you could argue with me on that. Um, but B class, C class tends to do fairly well during recession, um, and that's because hey, when recessions hit and people lose jobs or whatever, people go from A class to B class. Like the guy who was willing to pay 3,000 a month for the really nice luxury place, maybe he needs to cut back, so he goes from A to B. Um, Needs a lower rent, but is a nice B class property that's nice and clean and still has some amenities is very enticing for him. So that's where I'm kind of focused, was in that C to B range for that reason. I think the reason that multifamily tends to be fairly recession resistant is, hey, at the end of the day, people still have to have a place to live, right? And I know this seems very generic and very easy, like a very easy answer, but it's true. At the end of the day, we have a shortage of housing in this country. Um, There's not a ton of new product coming online right now because builders have paused, right, for the most part. So, existing inventory is going to have a lot of demand. I do think that we're going to start to see some defaults, and not necessarily because of the lenders, but because of people who overpaid and put really risky debt on the property. I think we're going to see some defaults. So we may see a period where, because of defaults, that prices kind of values drop a bit. Um, so I think that's going to be, I think that'll be a little bit of a challenge. But hey, if you're in a good position and you've got liquidity, defaults can be a bargain hunting time for you as an operator, which is quite frankly where me and my business partner are putting ourselves right now. Is we're keeping liquidity on hand and we're not going out and chasing properties, because there I think there's going to be some pretty good deals coming down the pipe.
100%. And right now, I think there's two types of investors. One type is saying multifamily is a falling knife, and they're kind of waiting it out to see what happens. And then there's the other kind of investor that's more their transfer of wealth is coming, and investors are always looking for deals. And I wanted to know. I know in the past you've said that as a real estate investor, there isn't going to be like one deal that makes you. It really is it's the stacking of multiple deals. And so, can you talk about the long term aspect of real estate investing and how it really builds over time?
Yeah, yeah, yeah. So, my business partner and I kind of talk about it in terms of like a baseball game. We talk about things in terms of like singles and doubles and triples and home runs, right? And then there's the grand slam. Hey, a grand slam may change your life real quick. I'll give you an example. Back during COVID, I missed on a property. I won't go into why, but I missed on a property. Could have had it for not much more. Today, that property is retrading, and the guy who bought it that beat me on the deal is going to make about $14 million in 2 years. That was a grand slam that I missed, right? um, that would have been a life changing event. Um, However, in that same period of time, over the last 2 years, to your point, I've stacked a lot of things on top of each other. I've built a scale of right around 1,100 units, and over the next 4, 5, 6 years, that's going to be a $7 to $8 million payday, right? So that is life changing, one deal at a time. um, and the beautiful thing about it is that you can do that 20 units, 30 units, 40 units at a time. To your point about like the knife falling and is it the right time and stuff like that, I look at it like this. I sat in a conference and I listened to a guy who went from basically broke to $40 million in net worth in about a 10-year period. And they asked him, how'd he do it? And he said, well, apparently I overpaid for a bunch of properties. If I'm listening to what everybody else said at the time, I overpaid for a bunch of properties. And that's kind of a lesson, if you will, is if you buy good assets, you buy them in good markets, you don't trade cash flow for, appreciation and equity, that kind of thing, then over time, it's going to work and it will absolutely build your wealth. And you kind of mentioned, hey, there's this transfer of wealth coming. There's always a reason to wait, right? Like during COVID, people didn't want to buy because they didn't know what COVID was going to do. In 2000 and in 2021 and 22, people didn't want to buy because prices were skyrocketing. Today, people don't want to buy because interest rates are high. It's like there's always a reason. But I kind of look at it from, at the current rates, at the current price, if it cash flows and pays for itself, and I can hold on to it through most issues, most problems, most dips, I'm going to buy it, especially if it's in key markets like Durham or Raleigh or Charlotte or Greenville, South Carolina or Charleston. I'm going to buy those properties because over time, they are absolutely going to pay off. You just got to get through the dips. And again, I have this conversation at least 3 times a week. I'm like, there's always a reason not to do something. Always. It's like at some point you just got to say, it checks all these other boxes and I can get through all those other reasons, right?
Yeah, one of my biggest takeaways from this conversation is your perspective on here. This was evident in the way you really handled yourself after the 2008, uh, I guess, situation that you found yourself in. Can you briefly describe your relationship with failure and regret? And how maybe you just haven't let that hold you back and keep you from reaching the success you're at right now?
Yeah, so I always take it back to this. So I played football growing up, and my freshman year I got called up to varsity, and I'm just going to go ahead and tell James thank you because I've lived by something he said to me, and I hope this is okay because there's a couple of four-letter words in this, but anyway, so I got called up to varsity my freshman year because one of our starting defensive players got hurt, and we went out there, and my first game was against one of the top teams in the state. And I went out there in the very first drive of the game. They ran the same play at me over and over and over, and they just kept planting me in the dirt. Right? It was a lead jet sweep. The fullback was leading around the end. The running back's coming right behind him, and I was just getting my butt handed to me. And finally, I walked off the field. They scored a touchdown. Walked off the field. I walked over. James was the guy that was hurt, and he walked over. He goes, "Man, that looked like it hurt." And I'm like, "Yeah." And he goes, "You tired of it?" I'm like, "Yeah." And he goes, "Well, do something about it." You know. And that stuck with me forever. Is like every time have some failure, I have a choice. I can sit there and sulk, or I can do something about it. And that's kind of how I looked at 2008 and nine. Is I could sit there and sulk, and I could just lick my wounds, or I could fix it and learn from it and then do something about it. And that's kind of how I look at failure as a whole. Is you have a choice. You can let it kick your ass, or you can pick yourself up and do something about it. And that's just kind of my short story on it. You can always just hit me up at my email, so tvest@harvestpg.com, or catch me on LinkedIn. I'm on there all the time under Tim L. Vest. Or you can check us out at Makin Moves. That's me and my business partner, Team Vitaly.